day. Look, if you're an Aussie business owner and you've got a self-managed super fund, then this is something you'll want to pay close attention to. We're talking about a strategy that connects your business premises, your retirement savings, and, well, that massive roadblock that stops most people cold, stamp duty. So how do you turn one of your biggest business expenses into a powerful asset for your future? Let's dive in. All right, just think about this for a second. Every single month, your business is cutting a check for rent, right? And that money, it's just vanishing into your landlord's bank account. But what if you could pay that rent to yourself instead? Imagine that cash building up your retirement nest egg, not someone else's. That's the game-changing idea we're going to unpack today. Okay, so first up, let's tackle the big why. I mean, why would you even go to all this trouble? Well, as it turns out, the benefits here can really, and I mean really, change your entire financial picture. The perks here are just fantastic, and they all work together. First off, your business pays rent, but it's going straight into your super, turbocharging your savings. Then there's the tax. That rental income gets taxed at the super rate of just 15%. Or, get this, it could be zero. Yep, zero, if you're in the pension phase. A huge one is asset protection. If your business, God forbid, hits a rough patch, creditors generally can't get their hands on the property. It's safe inside your SMSF. And maybe the best part? You're the landlord. No more worrying about leases, you've got long-term security for your business. It's a win-win-win. All right, now before we all get a bit too carried away, there's a massive hurdle we need to talk about. You can't just shove any old property into your SMSF if it's coming from you or a related party. Nah, it has to meet a really specific legal definition. It's got to be business real property. And honestly, this is the very spot where a lot of people come unstuck. So here's the guts of it. The official ATO definition is pretty clear. It's land and buildings used wholly and exclusively in a business. Now, those two words, wholly and exclusively, you need to burn them into your brain. They are absolutely non-negotiable. They're the key that unlocks this whole strategy. So let's break that legal talk down into two simple tests. Like a checklist. First, you've got to have an eligible interest. Now, that just means your SMSF is getting a normal freehold or leasehold title over the property. Simple enough. Second, it's got to pass that wholly and exclusively test we just talked about. Basically, the property's main gig, its dominant purpose, has to be for business operations. Now, a tiny, insignificant non-business use might slide, but the primary use, it has to be all business. Okay, let's make this super practical. What's in and what's out? An office, a shop, a factory? Yep, that's a clear yes. Even a vacant block of land you use for business parking, that counts too. But what about shares in a company that owns property? Nope. The desks and chairs inside your office? Absolutely not. You see, getting this distinction right is so important if you want to stay on the right side of the tax office. All right, now for the part you've been waiting for, the real game changer. This is the bit that can literally save you tens, even hundreds of thousands of dollars, and makes this whole strategy, well, just so powerful. We're talking about stamp duty. And I can hear you thinking it already. Hang on a minute. Isn't transferring property crazy expensive because of stamp duty? And you're right to think that. We all know transfer duty can be a massive bill, often making a move like this totally unaffordable. But what if I told you it didn't have to be? What if your total stamp duty bill was just this? $20. I know, it sounds completely bonkers, but in some states like Western Australia, this is a real figure. It's called nominal duty. That's right. For the price of a decent lunch, that could be all the stamp duty you pay. Instead of getting slugged on the full market value of your property, you might just qualify to pay a tiny, flat, nominal fee. This is the massive saving that makes this whole thing possible. But as always, there are conditions. So, to get this incredible discount, you have to play by some very strict rules. First, your fund has to actually pay for the property. It can't just be a gift. The lawyers call this paying consideration. And this is super important. If you're the one transferring the property into the fund has to hold it for your retirement benefit and your benefit alone. No other member can have a slice of that particular pie. So let's say your property ticks all the boxes and you reckon you're eligible for nominal duty. The next logical question is, how do you actually, get it into the fund? Well, there are a few common ways to do it. Okay, you've basically got four main pathways, and each one has its own pros and cons. If your SMSF is cashed up, an outright purchase is the cleanest way to go. Option 2 is an in specie transfer. That's where you contribute the property itself instead of cash, but you've got to be super careful with your contribution caps. Then there's co-ownership, where your fund buys a share of the property. And finally, if you need to borrow, the fund can use a special, very specific type of loan called a limited recourse borrowing arrangement, or LRBA. Look, each of these is a huge decision, which is why getting expert advice is a must. All right, time for a little reality check. As powerful as this strategy is, it is absolutely not a free kick. It comes with a heap of strict rules and some very real risks that you have to understand right from the get-go. So this is the fundamental trade-off you've got to weigh up. On the one hand, yeah, you get these incredible tax benefits and that brilliant asset protection. But on the other hand, you are tying your retirement savings directly to the success of your business, all locked up in one single large asset. That lack of diversification, that is a massive risk. And remember, property isn't like shares, it's illiquid. You can't just sell off the bathroom if you need a bit of cash to pay your pension. And the rules don't stop once the property is in the fund. Oh no. The ongoing compliance is absolutely non-negotiable. The tax office demands a market valuation for the property every single financial year. Your business has to pay proper commercial market rent. No mates rates allowed. And here's a big one. If your business gets into strife and can't pay the rent, your super fund is legally forbidden from giving it a loan or any sort of helping hand. Breaking these rules can bring a world of pain down on your fund. I think this quote from SMSF just hits the nail on the head. It says you can't just look at the investment merits, like the tax breaks. You have to think about the people involved, the members of the fund. You've got to ask yourself, is this one property really the right investment for my retirement? Will it give me what I need long-term for income, for growth, and for cash flow? And that really is the ultimate question, isn't it? Transferring your business property into your SMSF can be an absolutely brilliant move. It could save you a fortune in tax and effectively lets you pay rent to yourself. But it also means your business's fate and your retirement's fate are tied together. Is that a risk you're really willing and, more importantly, able to take? Now, of course, please remember, this is all just general information to help you get your head around the topic. The rules here are incredibly complex and they can trip you up. So before you even think about taking a single step down this road, getting proper, professional, financial, and legal advice tailored to you, well, it isn't just a good idea, it is absolutely essential. Thanks for joining me.